All right, so that's sort of what we're talking about there. Now, I got to get to John's question. John's questions and comments. So I logged on to my account at Radioactive Trading, showing the Fusion subscription, the blueprint. John says, I've resubscribed after my thankfully short medical sabbatical. That's fantastic, John. We're excited to hear that the medical sabbatical you had was shortened and shorter than we had hoped, actually. But John says, having reread the blueprint often during my downtime, I understand the income methods, the 12 income methods we use on the married put to generate income, lower risk, potentially bulletproof the trade. However, I think it can be a bit confusing when determining which to apply. There are cheat sheets that are available. So let's see here. I'm going to go to the members-only webinars and white papers. And, of course, I'm in the wrong field. I'm going to go back to the blueprint one. Latest blueprint revisions, income method cheat sheet, something that's shown for blueprint owners here that sort of talks about when to use it. You know, consider bullish income methods. I'll just say it, 1, 3, 4, 5, and 6. Stock moves up 5 to 8%. John, this is in the blueprint owners only section, the revision section. My fear is that you looked at the standard cheat sheet, which didn't show this concept here, that consider bullish income methods when the stock rises. This one goes on to talk about what happens if the stock stagnates and what you'd consider if the stock falls. In addition to that, for blueprint owners and radioactive traders as well, oh, sorry, folks. In the members-only section for the webinars for blueprint owners, there's one from about 2 years ago called the 12 Income Methods in Review. I'm going to be honest, it's long. Okay, it's longer than our normal webinars. It's almost 2 hours long. Why? Because we cover all 12 income methods, the pros and cons of each, when you would use them, and when you shouldn't use them. Okay, so each income method has its own time period selected. So it's a bit long, but the combination of, I think, that more in-depth cheat sheet, income method cheat sheet in the blueprint update section, that's where you find it. It's in the blueprint revision and update section. And this webinar for blueprint owners on the 12 income methods in review is going to better answer those questions of when to use those income methods if you haven't felt they've been answered for you through the blueprint and through the other webinars you've attended. Now, going back to what we saw earlier for Lance's question, we addressed that part for John. Going back to that, the married put search, a follow-up comment here is that, from John, is also, it seems it would be important to enter a long put position while it's, and the stocks, he means a married put, but while the stock and the put volatility is low. You know, positive growth in the stock usually leads to decreased volatility in the options, and a low starting IV would mitigate the decrease in the put's value. Is that a factor in your stock selection? The answer is no. However, if you fear that you're going to be overpriced by buying a put option that matches the criteria, simply use the percent implied volatility range field and limit this to less than, say, 65% or less than 50%, whatever you're comfortable. What is this? The percent implied volatility range, John, is showing you where the implied volatility on your option is now compared to where it has been over the life of the option. Yes, I got burned once. El Paso pipeline, years ago. Thought I did my due diligence, didn't do enough. Got into a married put. Position had a 6% risk. That's the most I could have lost. And what I didn't see from 3 or 4 months back in the headlines is that they had ongoing negotiations about a lease, I think in Brazil or somewhere in South America, for an oil field. And while I was in the position, what happened is that Brazil said, no, you can't get the rights to this field, to this drilling of this field. The stock didn't move too much. If it went through, it would have shot up, but they were so well positioned that even with this announcement, it's like, oh, it sucks, but it wasn't, their future wasn't even based on this. This just would have put them into a whole nother category of the big oil drillers or bigger oil drillers. It didn't happen. The stock didn't really move, but my put dropped from about $6 to $3.50 on that day. Why? Because the implied volatility range was at 90% when I got into it, and it collapsed back down to its range. I think I got in when the implied volatility was 0.7. It fell to 0.32 just on that news, even though the stock didn't move. I still wasn't at the full loss of 6%. Okay, that wouldn't occur till expiration. But I learned then to maybe start doing this. Now, the reason why I don't do it on a regular basis, John, is take a look at our search results. default radioactive screen, as I mentioned earlier, for Lance. And let me move this over here. Take a look at the right-hand side. In our last webinar, I added this in as an example. Even though I'm not screening by it, but the basic structure and the stock criteria we look for, notice that my implied volatilities are already restricted. The highest put implied volatility is 0.499, and the lowest I think I saw was 0.2408, 0.2376. So without even restricting volatility, I've pretty much restricted volatility to a tight range because all the criteria work hand in hand. If the implied volatility was too high, guess what? It wouldn't be in that 8% or less risk I'm looking for. Also, because of the stock criteria we're looking for, look at the percent implied volatility range field. There's one outlier, maybe two, and that's this one here. 73% implied volatility range, 60% implied volatility range. I might even consider the 53. Of these top 15 results, only 3 of them are higher than 50% of the implied volatility range, and only 2 of them might be even considered out of the balance for what I would trade. So it's not a bad idea to use that, but normally it's already factored in because of the other criteria. But I like the idea. I do use the idea. I do restrict the percent implied volatility range to make sure I'm not buying a put that has a high IV. Your risk wouldn't change. If the implied volatility range was at 90 when you got in and the maximum risk was 8% and then it fell to 30, still the worst you can lose is 8%. All that shift in implied volatility might mean is it's going to be not as beneficial for you to roll the put up or down because you paid into a higher premium and now it's lower. But that's the same with any option, isn't it? Whether you're doing a diagonal calendar spread and bought into a high IV, or you sold into a low IV on a covered call and then the volatility spiked, like we saw last Wednesday when the Dow dropped 600 points. Now it's much harder to manage because it's going to cost you more to buy to close. Well, the stock fell, so it's not going to cost you more to buy to close that call. But the implied volatility extrinsic value would have increased with that implied volatility gain on the option that you sold. Okay, so take a look at those 2 Blueprint owner presentations I mentioned, the 12 income methods in review, John, as well as that cheat sheet that's located here for Blueprint owners, the latest Blueprint revisions and updates. This is a more expanded cheat sheet than I think the one you stumbled across. I think this one, as I mentioned, you can see on the first one there, if the stock, let's see if it loads up here. Yeah, if the stock rises 5 to 8% or 3 to 6% in the first 30 days, this is what you might consider as a bullish income method right away. This goes further on to explain which ones you do in neutral, which ones you do in bearish. Okay, it's only available for Blueprint owners there. All right, now that's for John. I think I answered those questions. Oh, and then the implied volatility range, you can use that if you're worried about buying into overpriced options. You can add the percent implied volatility range to your columns as well so that you can see there and use that as part of your decision making process in that fact. Okay, let's go back to the top here. All right, so after John, I have Todd. Todd's still with us. Thank you, Todd, for remaining. And I'm not sure I understand this question. Todd says, if you had a scale in plan, do you treat each position with a married put as a separate trade? A married put. Oh, okay. I think I get it. Do I treat each position with a married put as a separate trade? Yes, I do. I think. Scale. Oh, I see what you're saying. Okay, so now I've got it. Not something I do personally, Todd, but I have several customers that do it, and it's worked out well for them. So what Todd's referring to is, let's say AMD here. Let's just take this stock. This is a sample trade where the put expired a long time ago. But let's say I originally bought AMD back in 2018 at 976, and I was holding the 12 put for January 2019 there. And in the first few months, the stock went up to 11. So rather than just roll this put, or maybe I will roll this put, but in addition to that, I'm going to buy another 100 shares at 11 and buy a 13 strike put. And maybe I rolled this up to the 13 strike put as well. And then the stock moved up to 14. Okay, so then I bought another 100 shares at 14, bought a 16 strike put and rolled these other previous existing ones up there. So now I'm at 300 shares and 3 puts instead of 101. Okay. Now, the trick to the question is, Todd, is if I kept all of the original position here, bought at 976 in the 12 strike put, if I continue to roll that put up via income method number 4 to the same strike of the new position that I just entered, then I might track them as a single position. What would I do? I'd go to position actions here. I'd go to edit position. I change my position to the quantity of 200 shares with the average cost basis, and then put in that I now have the 14 strike puts with those average cost bases as well to see the risk on the position. However, if your scaling idea means that you leave this position alone and maybe sell a call, but then on the next one you just buy 100 shares in the put, and the put is at a different strike and a different expiration maybe than your original, then yes, you have to track them as separate positions because you can't average the put strikes and the put expiration dates. But if you're moving them up all the same, and you're going to 500 shares, 700 shares, 900 shares, and each time you do that, you make sure you have the same put strike for all 9 legs that you legged into 9 times. You have the same put strike and expiration. You could count that as one position. You just have to average those as well. Okay, so yeah, this is a little different. Todd's follow-up questions are, what are the tax implications of married puts? Based on my reading, all of the trades would be short-term even if you have a married position that lasts over a year. That is likely true, because what I would do if I did one of the riskless spread trades, income method number 6, Todd, on top of the married put position, and it was 20 days out and it expired or it rolled up and I managed it, my broker might consider that as a short-term bear call spread, not as part of the larger trade. Okay, so that would be short-term. Most of my radioactive positions are done in a sheltered IRA account. Okay, so it's easy for me not to say it, but yes, likely even though you have a longer-term stock holding that you're doing adjustments against, just like it comes into play, just like it comes into play just like a covered call, I believe, Todd. Think about it that way. Whether you sell a call against the stock, you sell a call and buy a call with one of the spreads, you're still doing a form of covered call position. And then the tax implications might just be that your broker looks at that extra long call as a short-term gain or short-term loss, depending how the extra leg of the spread went against the stock. And then the other tax implications will be just like the covered call. Okay, so yeah, even though it's a longer-term trade, you've been holding it for a year or more, they might want to look at it as the short-term contracts, gains and losses, depending on how that pans out. Oh, Sam's bull put that he got a $3,600 profit on. I'm sorry, he mentioned Lulu as a bull put. He's in. He got $3,600 on the SPY bull put as well. Okay, so let's see here. Okay, this is a question that came in earlier, and it was from Louis, and Louis left. I'll address that later. I'm not going to get into this now with, I don't mean to say it though, I'm not going to get into this right now here. So Louis' question comes down to, I'm just going to use a custom spread. Shoot. I'm sorry, ladies and gentlemen. Let me stick with Ally, even though it's not the best for this type of strategy. So Louis had asked earlier, is there anything for a synthetic calendar diagonal? No, you're already the synthetic when you're in a calendar at a diagonal. Okay, so let's say on Ally, I want to do a calendar call, diagonal call. Stock popped up today, 27. I'm going to buy the 26th December, and I'm going to sell the 28. Whoa. I'm sorry, that's not what I wanted. I'm going to buy the 30. I apologize. I was thinking of the stock price for Urban that we looked at for Paul's question, not what we were talking about with Ally for the married put screen. I'm likely going to go with the 29 or the 30. Let's call it the 30. Buy the 30 call for December. A couple points in the money. And we're going to sell the 30. Oof, got to sell the 33. It's the only thing with any decent premium that's not already in the money. Okay. So here's my diagonal spread. that profit and loss chart. Not fantastic. There it is. So Louis asks, is there anything for synthetic, calendar, or diagonal? No, this is it. This is the synthetic. What is this synthetic of? It's a synthetic of the synthetic collar we discussed a couple weeks ago, meaning that if I bought Ally at 32.57, bought the 30 strike put for December, and sold the September 33 call. It would be the same exact risk-reward profile. It'd be a calendar collar. The diagonal is a synthetic of the calendar collar. Okay? This is the synthetic. It's no point in trying to mimic a long call with two options and pay extra commissions, or mimic the short with using two options, a short put and a long put, or something along those lines, where you'd have to pay more commissions. This is the lowest cost, lowest number of legs trade you can get with the lowest margin requirement you can get for this risk-reward profile. Okay, that's it. 2 legs gets you this. Any other combinations would be 3 or possibly 4 legs, more commissions, more confusion, more obligations to pay attention to. Okay, that is the synthetic. That's it. The advantage of the diagonal collar is that the monetary risk would be the same, but it would only be 2% or so of what you'd invest by owning the stock, buying the December put, and selling the call. Paul has some likely other comments on that. He was doing calendar collars for a while, sometimes with weekly options of the short, sometimes not. From the discussions I had, I think he felt that this synthetic wasn't really matching his, the collar, the dynamic collar, the calendar collar, was not matching his trading goals, and he didn't want to take the high monetary risk necessarily of a diagonal. And then he tried to do that for a while. We had some good conversations about it. But again, Paul's asking the new questions now related to these out-of-the-money, low-cost long calls. So he's learning, and he's expanding his horizons. He's doing things that I don't necessarily do. But that's the case there. So Luis, the calendar or diagonal 2-leg trade is the synthetic. Another way to describe it is, what is the synthetic? Well, when we saw the earlier synthetics, we were talking about the synthetic married put is 3 legs instead of 2. It's not always the lowest common denominator, but you can reduce risk, reduce exposure, and have a potential higher percentage return. The diagonal by itself is the lowest denominator. It's 2 legs to match the same risk-reward profile that you might see with a 3-leg collar trade, or maybe even a 5-legged synthetic stock position plus a put. Oh God, yeah. Synthetic stock position plus a put with an extra short call, which creates a sort of calendar bull call debit spread with a calendar bear put debit spread. So it's 4 legs to get this. Okay, there's no benefit in doing that, in my opinion. There's no benefit in creating a synthetic here, mimicking the collar by using the synthetic, but trying to mimic the diagonal risk-reward ratio. See how confusing it gets over time? It's why do something in a 4-leg option trade that doesn't really change the dynamic of leverage when you can do it in 2? That's kind of the idea. Could you enter something like this at a credit? Perhaps. I can create a reverse calendar put spread that has this same risk-reward profile as the calendar call spread. I'm using put options to do a neutral to bullish position, like a bull put credit, but diagonal. Which is better? Well, are they parity trades? Yeah, they're pretty close to parity trades. Okay, so same strikes but reversed. So if I kind of went into a position where I bought the 33 strike put and sold the, no, that wouldn't work. Yeah, it's still this, but not what you'd think of for a calendar put, right? If I bought the in the money, deeper in the money December 33 put and sold the, see, I'm confusing myself now when I talk about these synthetics. I apologize. It'd have to be the same structure. Yeah, it would be the same structure. Lower cost, $1.90 for the 33 put, and then September selling the 33 put. Okay? So I'm buying the December 30, selling the September 33. Same structure I had with the calls, but using puts, the exact same risk-reward profile. it looks like a high return because has a lower cost. It's almost done at a credit. Now, what's the subtle issue here? For calls, this was out of the money. For puts, that's in the money. I might be forced to buy shares of stock tomorrow at 33. Now I have a married put, that's true, but that's not the structure I wanted, is it? What did I do by trying to create a parity trade using different options? I changed the rights and obligations to where I now may be forced to buy shares of stock because I had to sell an in-the-money put instead of an out-of-the-money call. And if I get assigned, I'm now in a married put position. Is that what you wanted? To mimic the profit and loss chart of the calendar call spread? Probably not. Okay, so what did you get though? You got a much lower cost. It's a parity trade, not necessarily a synthetic. Reversing what you'd use in a diagonal call spread by using the puts, but you change the obligation and you're holding an in-the-money put, which you may be assigned on early, which is probably not what you wanted for the structure of the trade. Okay, so, oh yeah, and then Sam, of course, mentioned that these gets hurts on volatility crushes in that sense as well, okay? All right, let's see here. Sam's talked about his gold portfolio there. All right. Okay, Todd, I'm sorry, says thanks for the response, first time in webinar. Try to log on more with more questions. A blueprint owner and doing some research before I start treading the waters. Excellent. Okay. Sam mentions he's buying UVXY even today because you expect the market to go sideways if not drop. Yes, I'm looking at the VIX calls again as well. Okay, so in addition to the spreads, that's something we didn't talk about today. We've talked about before. If you are doing a spread portfolio, possibly even planning on doing a portion of those deep out of the money long calls, as Paul had mentioned, okay, as part of your portfolio, it might not be a bad idea to look into buying a couple of shares or calls on the VIX as a market hedge, so when it falls and those out of the money long calls start hitting those 100%, 90% losses, the gain perhaps in those contra ETFs, the volatility ETFs, might help counter some of those losses, so you're not stuck in that those large losses in that case, excuse me. Okay, so that's in the concept. Earl, I'm going to answer your question via email because we're already at about 6 p.m. Eastern time. So Earl, you had to leave the presentation and you were talking about adding something to the chain. We have no plans right now to add long butterflies to that spread chain position, the strategy chain you're talking about. But you can still use the custom spread tool to analyze long butterflies, and you can still enter long butterflies into the portfolio as well. What's a long butterfly? Well, it's just what he means by long is an all call, of course, or an all put butterfly. Instead of doing a bull put credit spread and a bear call credit spread where the stocks have the same expiration date, I'm sorry, the short options have the same strike price. What we're talking about is simply just entering into a butterfly, which I can enter as a call butterfly or a put butterfly. You know, you can track those. Now, his question is related. Well, I'm here, I'm answering it, so I might as well continue on. His question here is about the spread chain. He means the strategy chain, I'm assuming, where we have show the put credit and call debit parity and the call credit and put debit parity in that case. And could we add butterflies to here? The answer is most likely no, because what Greg and I are planning, yeah, and it's not just Greg and I, of course, but Greg and I are working on the idea of creating a separate tool like this for the spread chain, one that shows diagonals, right, to compare different diagonals that come up. I'm not sure on that one yet, but the main reason why is to show condors and butterflies, four-legged trades instead of two. Keep it off of this page to make it less busy. Just keep this with the two-leg vertical spread ideas, but then have a condor butterfly, which would also perhaps lead into a ratio spread chain as well, chain, I should say, as well. Okay, Earl, so sorry I don't have a better answer for you. You can put the butterflies in the portfolio. You can look at them on the profit and loss chart on the custom spread tool, but we probably wouldn't put it in this screen, and it's probably not going to be a strategy by itself. We're just going to create perhaps a butterfly chain and maybe later down the road a ratio chain as well to look for this kind of positions also. Okay, all right. Okay, well, ladies and gentlemen, I don't see any other questions that have come in. We took care of Earl, took care of John. We took care of Paul as best I could, answered Lance's questions. as best I could again. I just want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. As I mentioned, I may post for Fusion subscribers a trade on Ally next week, Ally Financial. It might be something different. It'll depend on how the market opens on Monday and Tuesday, how I manage my existing Fusion positions, and what capital I'm looking at to move forward in the last 3 months, last quarter or so of this year. So we'll take a look at that. It might not be Ally, it might be something else. But again, that was just used for example purposes, not a direct recommendation. Options involve risk. We talked about a lot of those today, didn't we? And it may not be suitable for all investors. Now, I know a lot of today's beginning presentation, and as we have been doing the past few weeks, I'm going to split this up into sections. Lance's will be a published webinar, of course, just on Lance's questions. Then Paul's will have his own webinar section instead of having them linked together. And then I might actually incorporate part of John's question into Lance's question about the search criteria. In fact, I think I'm going to put John's and Lance's together, Paul's separate, and then the remainder of the questions will be after that as well. We talk about parity. But you did see a lot of the tools today, didn't you? We talked about some of the tools for the search capability, our default searches that we've put in that we would trade ourselves in the various strategies. If you want to see what we have to offer, take a look at that portfolio tool for evaluating positions, spread chain tool we showed at the end. Hey, just go to PowerOp.com, put in your first name, last name, and email address. No credit card or billing information is required. We can't bill you, okay, unless you decide to subscribe, so there's no risk of that. And then just click Start My Trial, and you have full access to Power Options for 14 days. After the 14 days, subscriptions start at $45 per month. We do offer a variety of different levels of service depending on the data and if you want access to the historical suite of tools. We talked about some of the education on the webinar archives and on YouTube. A lot of those webinars I posted are available in the Power Options webinar archive, powerop.com/webinars.asp. The ones from last Friday that were broken into those different segments currently aren't on the archives. They will be later on this weekend, and we'll see about getting these portions of today's webinars up as well. But remember, you can just go to YouTube and search for some of those we talked about, the 3 core principles and trading comparisons. We talked also about the Managing the Long Haul webinars, our thoughts on managing long hauls, which is in the webinar archive for Paul as well as on YouTube also. And then, of course, that strategy comparison, the stock comparisons we discussed, Trusting the Search Results webinar is also there as well. Okay. Well, I want to thank you all for your questions. I know this took a little bit longer than I expected. I was hoping to only spend 10 to 15, well, 15 to 20 at most on Lance and Paul's questions, but we extended that a little bit. We'll take a look at the recording here. We'll see what needs to be cropped out and put into what place and maybe changed or edited a little bit if any mistakes were made, and we'll try to get the archive posted for you as soon as possible. If you think of any other questions this weekend, just remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can call us during market hours at 302-992-7971. Remember, trial members and subscribers can schedule a coaching session at any time, and that's essentially just a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Well, Lance, Paul, John, Earl, Sam, I thank you all for your comments and your questions. I hope you feel you got a worthwhile response from what I had planned for the answers to your questions and the questions that came in on the fly. I hope everyone enjoyed the presentation today. I hope everyone has a fantastic weekend, and I look forward to seeing you all next week on Friday the 13th for our next open discussion Q&A session. Take care, everyone. We'll see you soon. Good night.